Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping on every order, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 40,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend high in the Denver Hills, Dave Kranzler. Dave, it's great to have you back on the show here.
Great to be here again. Thanks for having me. I'm not really high, though.
We didn't say that. We said high up in the hills.
Oh, okay. Yeah, but I know what the implication was.
Yeah, we're in a good mood today because gold and silver are ripping higher after both metals were capped for about a week leading into options expiration and really the Fed minutes here midweek. Gold had been capped in a tight range between 12.30 and 12.40. Silver had been capped really in about a 10-cent range between $17.90 and $18. It kept knocking the ceiling at $18, and they both busted through those levels on Wednesday afternoon when the Fed minutes were released. And really the past 48 hours have been really nice to see for gold and silver. And gold's up about $20. It's traded at about $12.60. Early on Friday, it's trading right now about $12.58 here in the afternoon access market session. Silver traded as high as, I think, $18.42, 44, and it's trading right at about $18.40 right now as March silver looks to go off the board and switch over to the May contract. So let's start with the action in the metals here. Particularly with gold, we now have gold knocking right on the door of its 200-day moving average, and silver actually is now, about 40 cents above its 200-day moving average. So pretty good signs to see here, don't you think, Dave?
Oh, absolutely. No question about it. And I think there's a whole plethora of reasons why metals are performing so well right now, especially in the face of the Fed, with their continuous daily threats to raise interest rates again. And so hopefully we can flush some of those reasons out on the show today.
Why don't we start off the conversation that, you guys are going back and forth before we flip the recorder live on the share market here. Gold and silver are ripping higher, but the shares are lagging a bit behind here today. What's going on, guys?
Eric, I defer to you because we have different views on this.
Yeah, well, it's nice actually that we do have a slightly different take, because when we flesh out what we're seeing, it gives a nice synthesis in terms of our perspectives, because I actually agree with Dave's perspective and correct me if I'm wrong in my summary of your position and take on what's up, Dave. We definitely have seen a really large move in the mining shares since, roughly a couple days before Christmas when we bottomed, and through this week. So it's normal to see consolidation in miners. But I think that what we're seeing right now is that the miners have literally in the last 48 hours been leaned on, because earlier this week it looked like, we've had a huge amount of, for example, contract issuance on the COMEX and the silver pit to absorb all of the growing interest of new longs or existing longs wishing to come back into the market or elevate their positions. And, we have over 7% increase in open interest on the COMEX. Going into options expiration today, we're recording Friday, and silver bashing up against $18, and gold today in the last 24 hours getting over $12.50, which is an important signal level that people have been looking for to kind of give confirmation to all of the people who respond to technical indicators to inform their investing and speculating interest and decision-making processes. All this is going on at the same time. We have, a very favorable global macro environment. Other than maybe dialing down some expectations about the inflation pressures rising on a going forward basis, because people are beginning to, second guess just how much tax cuts the Trump administration Republicans would be able to push through Congress, combined with, the dialing down of infrastructure plans being over $1 trillion being floated around prior to the election to 500 and change billion talked about during the first week, and then now we're, who the heck knows what's going to happen as far as their plans. So, that whole inflation trade is in the backdrop, but gold and silver are performing really well given all the global macro stuff and the differences between policies in the Bank of Japan versus the European Union and all of that. And the dollar has been declining this week. It's weak now. The Japanese yen has been strong. All these kind of things are the kind of intra-market dynamics that we do see when precious metals are going up and then confirming that interest in the growing level of people wanting to get speculative positions as well as insurance-based positions, the longer-term players. So, we've had a really long move in the last 2 months of a heck of a lot of appreciation in the mining sector, but it just doesn't jive that we finally get over 1250 today in the last 24 hours. We see all of the backdrop conditions for continued follow through and momentum in the precious metals pricing, and lo and behold, miners start farting around yesterday and not really performing very well. And today, now as we're recording with an hour and 20 minutes left in the New York session before we close Friday, we have seen the GDX index go from the highs of the day of $24.24, and currently it's trading at, pulling up my quote here, it's at $24.20, and as the on-balance volume has dipped below a net 2 million shares negative, and it just basically fell apart from it started getting really pressured and going into the negative at 1 p.m. Eastern Standard Time. And the metals are fading right now too as we close out the week. And another thing too that Dave and I were discussing before we hit the record is we've seen other indications and hints that the physical market is stronger than what most people are giving indication to. Earlier this week, the LVMA had their London PM fix, and prior to it, gold began this leap higher, where we are now, going over 1250, and it's the significance of that is that the LBMA is still important for physical settlement, even though the market is basically a paper derivative clown show. It still has some import when it comes to how the rhythms of the global bullion market work when it comes to how mining companies process their settlements and bringing their doré to market, et cetera, et cetera. And precious metals have all of the fundamental stars aligned to continue to see some follow through. And the biggest fear that the cartel always has is momentum and follow through. And we've been through this for more than a decade in this, post 2000 birth of this bull market, where we've gone through periods where the powers that be, that are guardians of the fiat paradigm and all that it represent, go to war against any kind of momentum. And it's very hard to always ferret out what's going on a super short-term time frame, but it sure looks like to me that miners are being leaned on in the last 48 hours, in part to try to contain sentiment within the sector. And so Dave's argument has been more along the lines of, well, consolidation is something that's normal, that should be expected. I agree with that, but I think that the cartel also is of that same opinion, and they're taking advantage of that for psychological impact.
Dang, Eric, on balance volume, man, you sound like Joe Granville. I think he's the guy who was credited with inventing the on balance volume indicator.
Yeah, well, I mean, I'm not ascribing any particular technical signal import to it, but it's in terms of a descriptive nature. I mean, the bottom line is they're selling the crap out of miners today. And as we're going into the close, what the hell? I mean, we shouldn't be seeing that. And when we opened up in the morning, miners were strong, as one would expect, as carryover from Thursday, and the fact that options expiry today isn't a disaster. Surprise, surprise. You know, the cartel wasn't able to use option expiration as a means of crashing the sector. And I think earlier this week, when we saw the open interest in silver in particular on COMEX leaping higher, that is the footprints of an effort to sop up the rising interest in people going long in silver. And we see it in gold too, but silver was really, I mean, you know, silver what? It's trading under $18 and it's near its all-time high in open interest. What gives? Well, we know what gives. We know
I guess I have a slightly different perspective on it, and I'm not, at least as long as it doesn't persist, I'm not concerned about the performance of the miners. I mean, you know, on average and in general over the last 16 years, when gold starts moving higher and the miners diverge, it's usually signaled that they're getting ready to implement a big takedown of the price of gold and silver. And so far they haven't been able to do that because this has been going on for, I don't know, 3 or 4 days at least, that the miners have been lagging the bullion. And then
right.
in the gold and silver, I mean, I honestly, after yesterday, I woke up this morning and I expected to turn on the ticker on, the financial channel du jour that I wanted to watch and see gold down a lot. And I was like, whoa, it's up again.
Mm-hmm.
And I think there's a more wide, even though it's still a small percentage of the overall investor universe, I think there's a more widespread audience interested in owning any form of gold, whether it's paper, physical, whatever, now than there ever has been. And I think that's making it a little more difficult for them to implement their manipulation strategies. But what was interesting, and I meant to write about it in my my mining stock journal for the issue that was out last night, and I just didn't get around to it. But I noticed when everyone really started buzzing about the fact that the miners were lagging the direction of the metals was 3 days ago on the 21st, and Newmont, because I saw the Huey was getting killed and the metals were up on that day, and I'm like, this doesn't make sense. So I pulled up the Huey index and I saw that Newmont was down over 5%, and that was the biggest contributor to the decline in the Huey. And so I pulled up news on Newmont, and they released their earnings, and they slightly missed the Wall Street estimate for net income. But if you read through their earnings report, they had a phenomenal quarter and a phenomenal year. Their cash flow, their EBITDA was up 25% year over year. Their cash flow from operations, which is the metric I look at, and I think that's the most relevant for any company, their cash flow generated from their operations more than doubled year over year. Their all-in sustaining costs for pulling gold out of the ground was slightly lower, and their gold production was up 7%. So, and they also reduced their debt. So I'm looking at that, and I'm like, if the Dow company reported these results, and even though they might have missed their net income number, that stock would be up 10% today. And so I do think you're right. I think part of it was the hedge funds, algos dumping Newmont because they missed. But I do think that because Newmont was weak that day, because they missed their earnings, their GAAP earnings, I'm sure there was some heavy leaning on Newmont to try and push the Huey lower. So yeah, I do think there's some degree of intervention in the mining stocks. It's harder to prove that, though, as opposed to the metals market, where we can see it every day, and just in the COMEX open interest numbers. And and how those open interest numbers shift around relative to what the price of gold is doing. So, and also just the fact that, there's an ungodly amount of paper gold outstanding versus the amount of physical gold backing those contracts that are in the COMEX vaults. And that just completely perverts the spirit of what the futures market is all about. So, and again, I showed you that chart, and Doc, feel free to put it up on your site, but the 5-year gold to Huey ratio, and it's right now it's kind of at the median level of where it's been over the last 5 years, and it essentially in 2016 it kind of fell off a cliff, which means that the miners were screaming versus the price of gold. So if there's a little bit of a, whether it's aided by manipulation or not, if there's a little bit of a correction process whereby the miners are weak versus bullion for a short period of time, I'm not concerned about it. I mean, if we're truly in a bull uptrend, that ratio will head lower again, probably sooner rather than later.
Yeah, and just to reiterate for our audience, I mean, Dave and I totally agree on, the bigger picture and the significance of that kind of consolidation being completely normal and all that. It's just that in the last 48 hours with what we're seeing in bullion and the significance of 1250 and the significance of options expiry happening on this Friday, it just stinks. I think both cases are correct, and that it basically boils down to, and this is qualitative, I can't prove this obviously, but in my assessment based on watching markets for decades, that it's more along the lines of the managers of the fiat paradigm looking towards something, anything that they can grasp onto to try to slow momentum interest in the sector. The Newmont mining example you bring up, Dave, is a great example. And, gold going over 1250 today should have been eliciting more interest in miners. Instead, miners are rolling off a friggin' cliff. And frankly, the way silver and gold are fading going into our normal New York session close here and the after hours and whatnot, this is tape painting in an attempt to, next week, steer the sector down. And it remains to be seen whether or not they're successful in doing it, because there's been significant interest in accumulation of gold and silver in this last week. But that's what it looks like the powers that be are trying to do.
And they're not doing a very good job of it, though. I mean, we're coming up on the 3 o'clock hour, and silver's still hanging in at 1840. Gold's still 1258. So I got 1258.80 last. So I mean, they've knocked $1 off of gold, and they've knocked 3 or 4 cents off of silver. So if we can make a weekly close here today, it bodes some good strength for the future in my eyes.
Yeah, I would agree with that. And I think one of the primary factors is that I think the physical market, in terms of the amount of physical gold that's moving from the west to the east, or coming out of the ground and going to the east, is much stronger and much larger in volume than people realize. And obviously, Kuz Jansen put out that exhaustive write-up on the amount of gold going into China, and that the official sources are underestimating that amount. And it's hard for me to read his work because it's I like writers who economize, and he's the exact opposite. But I didn't necessarily need him to verify for me that was the case, because I've suspected that for several years, and that's based on data that I look at every day and I have access to every day. But I think it helped verify for a wider audience of fence sitters who wasn't sure if what we were saying about the amount of gold going into India and China was conspiracy theory or not, and that kind of affirmed that it wasn't. So I think they're having trouble containing the physical market, and I think that's part of the reason why, even though a lot of the numbers suggest that maybe this is the type of the time when they would be pushing gold a lot lower, and they're not able to.
Yeah, just to substantiate that, Dave, I'm looking at a chart here from the last 2 months of gold imports into Switzerland, country by country. And in the last 2 months, being the data lags about a month, so December of 16 and this past January, the U.S. and the U.K. combined exported just under 300 metric tons of gold into Switzerland.
Wow.
And actually the majority of that actually came from the U.K. I think 235 metric tons were exported from the UK into Switzerland in December and January.
The only way to get that kind of volume is tapping vaults.
Yeah, I mean, last I checked...
Maybe it's GLD.
Last I checked, UK is not producing 235 metric tons of...
Right.
coming out of below the streets of London.
Right.
And so for those who aren't following the picture, all that gold going into Switzerland is going into Switzerland because it's being refined and recast into 4.9 kilo bars and then headed to Asia. So none of that gold is going back to the west. That's all going to the east and never going to be seen again. So that's a pretty substantial amount of tonnage just for the last 2 months here.
Oh, that's huge. That's huge. And the day before China went on holiday for the observance of their Chinese New Year, there was 190 tons of gold were delivered into the Shanghai Gold Exchange. It was just an ungodly number, and I've never seen anything even remotely close to that in the several years I've been monitoring that number.
I think one of these days, guys, we should take a flight out to Shanghai and see if we can video blog the delivery of that.
I would love to do that. That's actually a great idea.
That would be something to see.
Yeah, so to recap kind of where we're at, the Fed job warning about March being a live meeting, yields on the 10-year and 30-year certainly don't look like we're looking at a rate hike in 3 weeks. 30-year yields are going back over testing support levels back under 3%. And the 10-year yields are testing support right now today at about just above 2.3%, and really nothing's indicating that a rate hike is imminent. And you've seen the response in gold and silver too here. So kind of recapping things, it's been a big week for gold and silver. Miners have been kind of pressed on the last couple of days, and Eric certainly thinks that the cartel has been doing the pressing. While stepping back at a bigger picture, there certainly has been a need to have a little bit of a consolidation from the massive move they had off of the December lows. But before we close, let's talk a little bit about GLD, Dave. I know we wanted to cover that a little bit.
Yeah, Eric actually had the original observation, so I'll let you go ahead, Eric.
It builds on what we were speculating and debating about when it comes to what's going on in this last 48 hours. And we, as an operating assumption, know that it's always the case that the cartel has a modus operandi of trying to maintain or contain momentum at all costs. Having gone over 1250 gold in the last 24 hours, having seen currency markets be incredibly favorable towards further momentum building in precious metals, et cetera, there really are no fundamentals that speak to the reason for why gold's move would, peter out. And miners have faded in the last 48 hours, and all of a sudden we see today, before the 1 p.m. Eastern time, something on the order of nearly 170,000 shares to the downside being sold on GLD before the miners began to crack conservatively this trading day. And then miners began to crack at about 1 p.m. After 2 p.m. Eastern, we see further acceleration to the downside. And all of this looks like tape painting, frankly. That magnitude of a move with GLD, sure, it's probably tied to, or it could be tied to, better said, options expiration moves and positions that may be multifactorial when it comes to how any given portfolio hedge fund manager might be dorking around in comics or whatever. But, in the grand scheme of things, in the context of everything we've seen this week, it really does look to me like the powers that be that are guardians of our fiat paradigm are kind of scared to death of the fact that gold just got over 1250, which is a level that a lot of people for weeks have been looking towards as their confirmation that the bull trend is alive and well. And they don't want that to be the going forward picture and sentiment backdrop that enters the trading for next week. So what are they doing? Well, they're grasping for straws. And yes, the miners were ripe for consolidation anyway, given the huge move. But the fact that we're seeing that happening, or the fact that we're not seeing follow through in miners and actually selling off into the weekend now, I think is pretty clear that, at least from a trading price signal point of view, in the context of everything else that we can place that price action into, it really does look like miners are being leaned on.
Eric, multifactorial, unbalanced volume. I mean, you've been flying out.
Yeah, I'm sounding like Jim Willie, huh?
No, you flying out to Chicago to take night classes at University of Chicago Business School? Multifactorial.
No, I leave that to you, dude. I wouldn't go to that.
When those words started coming out in my regression class, I had to hide under the desk. I was like, that's too many syllables for me. Unbalanced volume is 3 words, and that's too many syllables for me. I agree with you here. I mean, I would have said, maybe they're leaning on the miners, or maybe they're not. Who cares? But there's definitely evidence. There's footprints in the tape today because, as you pointed out, there was that massive volume. It was a 1-minute volume spike up to almost 170,000 shares, and it happened at 12:47 Eastern time. And then right after that, there was a small volume spike in GDX, and then a few minutes after that, GDX gapped down. And these are all on the 1-minute chart. So, it's kind of like, someone was messing with the hedge fund algos who were programmed. There's probably some hedge fund algos that key off of GLD and GDX, and that's how they do their intraday momentum timing trade. So, but again, for me, I'm not that concerned about it. I'd be concerned about it if we go into an extended downtrend in both the miners and the metals. But so far, the metals are defying all the bearish forecasts out there. Bearish forecasts, even from members of the gold investing community who are long-term very bullish on gold.
Yeah, and then the shorter-term picture sentiment signals that we can see with, like, for the example of the trading on the London PM fix action, or prior to the London PM fix action that we discussed earlier in the show as well. I mean, all of this kind of backdrop speaks to precious metals doing very strongly, and then what we're seeing today, and to some extent yesterday, is merely just the cartel grasping for straws and trying to paint the tape. And this short-term kind of analysis on the fly is very difficult to do. It's very difficult to prove this kind of stuff. But, after watching these market trends and the ways in which the cartel acts for more than a decade, this isn't the first example where we see them, picking any given straw that they can grasp at. And then today it looks like, GLD was hit pretty hard, and then the miners were leaned on periodically throughout the day. But after GLD's hit, all of a sudden the miners were being hit. Why were they being hit? We'll leave that as an open question for our audience to determine what they want to draw on their conclusions. But I think this is leaning on the miners.
Well, I'll add one other thing, Eric. It may not be as much 1250 in the psychological significance of 1250, well, that is significant, as much as the potential of what comes next, and that's the 200-day moving average. So we're only a couple of dollars away from, right about 1263. So we're within $4 or $5 from that. And yeah, I mean it's both.
I mean, it's a 1-2 punch. They want to stop the challenge of the 200 days, so they try to paint the tape when we're over 1250. It's both.
Right. I mean that terrifies them, because if gold breaks through that 200-day test and starts moving off of it, you step back and you look at a 10-year chart, Yeah, I mean, we've got one more resistance level, and that's the highs of last year, and then there's a massive gap in the chart. So,
and they're and for our audience, just to remind everyone, it isn't necessarily the technical indicators or on balance volume or what have you are important all in of themselves. It is, in fact, more important that, there's a huge percentage of speculators that are buying long paper gold, on the paper silver, on the COMEX and LBMA, and the cartel's scared to death of them taking the signals that they will traditionally interpret as bullish technical signals. That's what they're afraid of. And it's regardless of whether or not somebody subscribes to the thesis that the technical signals are of value or not. The cartel is afraid of the technical signals motivating a certain percentage of the people who are speculators that they're trying to fight back their interest in accumulating more paper, gold, and silver.
All right, so it should be an interesting week ahead, guys. I look forward to it. Pour yourselves a couple cups of coffee starting Sunday night when Asia opens. All right, well, Dave, it's always
Dave will be high in the hills of Denver.
But not high.
But not high. Mile high, Dave, not high. Have a great weekend, Dave.
You too. Why aren't we busting on Eric's chops here? He lives in a state with legal weed as well.
I'm at a lower elevation, so it's not as easy to pick on me.
All right. For the doc, Derek Jubin, and our good friend Dave Kranzler, thanks for tuning into this week's SD Weekly Metals and Markets.
Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping on every order, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 40,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Jubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend high in the Denver Hills, Dave Kranzler. Dave, it's great to have you back on the show here.
Great to be here again. Thanks for having me. I'm not really high, though.
We didn't say that. We said high up in the hills.
Oh, okay. Yeah, but I know what the implication was.
Yeah, we're in a good mood today because gold and silver are ripping higher after both metals were capped for about a week leading into options expiration and really the Fed minutes here midweek. Gold had been capped in a tight range.
Of reasons why metals are performing so well right now, especially in the face of the Fed, with their continuous daily threats to raise interest rates again. And so hopefully we can flush some of those reasons out on the show today.
Why don't we start off with the conversation that, you guys are going back and forth before we flip the recorder live on the share market here. Gold and silver are ripping higher, but the shares are lagging a bit behind here today. What's going on, guys?
Eric, I defer to you because we have different views on this.
Yeah, well, it's nice actually that we do have a slightly different take, because when we flesh out what we're seeing, it gives a nice synthesis in terms of our perspectives, because I actually agree with Dave's perspective and correct me if I'm wrong in my summary of your position and take on what's up, Dave. We definitely have seen a really large move in the mining shares since, roughly a couple days before Christmas when we bought them. This is going on at the same time we have, a very favorable global macro environment. Other than maybe dialing down some expectations about the inflation pressures rising on a going forward basis, because people are beginning to, second guess just how much tax cuts the Trump administration Republicans would be able to push through Congress, combined with, the dialing down of infrastructure plans being over $1 trillion being floated around prior to the election to 500 and change billion talked about during the first week, and then now we're, who the heck knows what's going to happen as far as their plans. So, that whole inflation trade is in the backdrop. But gold and silver are performing really well given all the global macro stuff and the differences between policies in the Bank of Japan versus the European Union and all of that. And the dollar has been declining this week. It's weak now. The Japanese yen has been strong. All these kind of things are the kind of intra-market dynamics that we do see when precious metals
between 1230 and 1240. Silver had been capped really in about a 10-cent range between $17.90 and $18. It kept knocking the ceiling at $18, and they both busted through those levels on Wednesday afternoon when the Fed minutes were released. And really the past 48 hours have been really nice to see for gold and silver. And gold's up about $20. It's traded about $12.60. Early on Friday, it's trading right now about $12.58 here in the afternoon access market session. Silver traded as high as, I think, $18.42, $44, and it's trading right at about $18.40 right now as March silver looks to go off the board and switch over to the May contract. So let's start with the action in the metals here. Particularly with gold, we now have gold knocking right on the door of its 200-day moving average, and silver actually is now, about 40 cents above its 200-day moving average? So pretty good signs to see here, don't you think, Dave?
Oh, absolutely. No question about it. And I think there's a whole plethora of...
And through this week, so it's normal to see consolidation in miners, but I think that what we're seeing right now is that the miners have literally in the last 48 hours been leaned on because earlier this week, it looked like, we've had a huge amount of, for example, contract issuance on the COMEX and the silver pit to absorb all of the growing interest of new longs or existing longs wishing to come back into the market or elevate their positions. And, we have over 7% increase in open interest on the COMEX. Going into options expiration today, we're recording Friday, and silver bashing up against $18, and gold today in the last 24 hours getting over $12.50, which is an important signal level that people have been looking for to kind of give confirmation to all of the people who respond to technical indicators to inform their investing and speculating interest and decision-making processes. All